Good morning. My name is Matthew Bell. I am the director of the SC Launch Program at SCRA, and it's Thursday, April 13th, and I'd like to welcome you to the current state of U.S. banking. In early March of 2023, there were signs of weakness within the U.S. banking system, which led to a run on one of our banks, specifically Silicon Valley Bank, leading to a potential for default of that bank in terms of the ability for its clients to be able to get access to services and loans. That led to March 10th, 2023, federal regulators took control of that bank, and it led to a major issue for liquidity within the tech and investor-based segment across the entire United States, and led to a ripple effect with other banking systems and questions as to whether there are weaknesses in that sector as well. For us at SC Launch, we had companies that were directly affected by this banking system failure, and we also had companies that were indirectly affected by this banking system failure. And although the situation seems to have taken care of itself in a short manner thanks to quick action by the Fed, there are still questions as to whether the banking system has underlying issues that could affect companies, early stage investors, early stage tech companies ongoing. So we at SCRA reached out to one of our trusted banking advisors with Ameris Bank, and are very thankful that Richard Sturm is Executive Vice President with Ameris Bank, is going to spend some time with us to talk with us about that issue specifically, walk us through a little bit about what occurred and why it occurred, talk about the stability of the banking sector in its current form, and then talk a little bit looking forward as to what are some things that we should be looking for and what are some things that we should be worried about. So Richard, I just want to thank you for joining us today and appreciate you taking the time to spend with us today.
Good morning, Matt.
To start with, could you give me just a quick background on yourself and Ameris Bank and your commitment to South Carolina? And we specifically selected you because we wanted this to be a South Carolina-centric discussion, and we, again, appreciate you taking the time.
Absolutely. Matt, we're a stable, conservative, well-capitalized, 50-year-old, $25 billion bank with 164 locations spread across 5 states. I've been a banker in South Carolina for the past 35 years. 17 of those years have been with Ameris Bank. We have thousands of customers in South Carolina, and we've lent hundreds of millions through our offices in Greenville, Columbia, and Charleston to all kinds of industries, including technology and innovation.
And this situation seemed to be unique to Silicon Valley Bank. There were other banks affected for sure, and there were questions as to whether other banks would fail. But that seems to be the one that the regulators focused on quickly and moved on quickly. Could you define Silicon Valley Bank for us and tell us a little bit about what that bank is and why it ran into trouble?
Yeah, absolutely. Yeah, first, understand the basics of banking is we collect deposits, and then we take those deposits and we lend to those and we make a spread. And that's the basics of how a bank makes money. When banks have excess dollars, like we have had during the last few years, one of the options is to invest in long-term bonds, which is exactly what SVB did. When rates rose rapidly, the value of those low-rate bonds declined. When SVB needed that cash, those bonds were worth $2 billion less. Second contributing factor, they had heavy concentration in venture capital related deposits and a large number of uninsured deposits. And finally, a tweet went out to the venture capital community suggesting they're a problem. The issues I just talked about above, 48 hours later, SVB had lost 20% of their deposits and they were insolvent.
And just briefly, we were hearing rumors of issues and companies pulling deposits out the week before that March 10th where the regulators stepped in. What is a bank run?
A bank run, that's a quick removal of funds from a bank. It's a bank's worst nightmare. Once you lose the trust of your customers and your depositors, it can be a rough ride, and you really need to be prepared for those situations. And unfortunately, they were not.
What are your thoughts in terms of the federal regulators stepping in on March 10th and taking control of the bank? It seemed like that was a bit controversial at the time. They moved pretty quickly by some standards. Just kind of curious as to your take on that situation and how they performed in that situation.
Yeah, I thought the move to ensure all the deposits was decisive, and it clearly had a stabilizing effect on the financial sector. Now, there were some ricochets for the next few weeks, but I think it helped stabilize. They did create a new fund as a result of the two failures to lend on bonds at par value, and that was to mitigate the losses that some folks were experiencing in their bond portfolio, and that'll help in the near future.
So just to clarify, your premise is that the FDIC's aggressive movement in this situation did stabilize the situation. You're feeling more comfortable that it's stable at this point because of it.
Absolutely. Absolutely more favorable. My biggest question is when did the California Fed know that these issues are going on? Why didn't they know, and why didn't they act? They certainly had the authority and the power to do what they needed to do to correct it. And those are some of the things that will come out in the investigations that move on. And we just don't know the answer to that right now.
Okay. So let's talk about Ameris Bank and kind of the response and the effect of the system on your bank. Can you tell us a little bit in terms of what your response to the crisis has been, and how you responded to it, and maybe some of the effects that this might have had upon the way that you're performing or the things that you're doing going forward?
Yeah, first I'd say that Silicon Valley was a completely different bank than Ameris Bank. We have stringent guidelines in place to ensure we're managing interest rate risk and concentration risk. For example, as much of 90% of the deposits at SVB were uninsured. We're at 50%. 2/3 of our depositors have been with us for over 5 years. 1/3 of them over 10 years. We're stable. We did not have investments in long-term bonds, and we don't have $1 million in unrealized losses. As a result, we did not see a reduction in our deposits.
And generally speaking, if you apply that to banks across the United States, do you feel like that is a similar situation for the majority of the banks that are out there, or do you feel like there's pockets that could be problematic?
And I think that the banking community as a whole, it has the exact same philosophy that I just drew out. Absolutely. Yeah. Silicon Valley had experienced extreme growth over a short period of time, and it's just, some industries can stand quick growth. The banking industry, it's just better to be stable, consistent, steady.
First Citizens Bank is headquartered in North Carolina with some presence in South Carolina. They did purchase portions of the SVB loans and deposits. Was Ameris involved with any of that process as well? And what impact will this have on the Ameris banking system with First Citizens having taken on some of that risk from SVB?
Gotcha. First, let's talk about what happens when a bank fails. First thing is the Fed moves in and they fire the senior manager, and they take over operations of the bank while it collects bids from interested parties and acquires. The successful bidder, once approved, then takes over the operation and life goes on. We had a lot of that during the last downturn. Matter of fact, Ameris Bank acquired 10 banks similar. They were smaller than Silicon Valley, but similar situation. In regards to Ameris Bank involvement in SVP, Ameris Bank's focus is in the Southeast and therefore would not have been interested in SVP.
So as we start looking forward and at the current conditions and the potential for this to happen again, what's your sense for the health of the South Carolina economy, and specifically for the innovation sector, which is an area that I suspect most of the listeners and myself are most interested in. What do you see, I guess, in terms of the health of the economy, and whether that will have an impact on the situation going forward or not, specific to South Carolina?
Yeah, right now, the economy is vibrant. Supply chain issues are subsiding. Unemployment's low. Underemployment's rising. The inflation numbers just came out yesterday. We're down to 5% from 6%. That's positive, but we're still above the Fed's target rate of 2%. Fed rate increases are slowing the economy. The question is, when's it enough? General opinion is that we're at the top of the rate increases, maybe some small moves, and then flat.
And speaking specifically to bank stability as an issue going forward, do you have any concerns in that area? And if you do, for how long should we be worrying about this?
The general feeling in the market is these concerns have subsided. The big question today is, when will there be a recession, and will it be a hard or soft landing? Mm-hmm. And that's really what we're focused on today.
Can you give us an idea as to where you see rates going in the 6 to 12 months? I know I'm asking you to predict a little bit as far as how the Fed's going to react, but I think for most of the audience and for myself, I'm most interested in liquidity and the availability of cash in the early stage investment space, and the availability of cash to specifically to small early stage innovation startups and companies in the space, and the translation of that innovation into commercial potential. Kind of curious what your take is on that liquidity and on the interest rates as well, going the next 6 to 12 months.
The general feeling is that we're at the top of the rate cycle, and there may be 1 or 2 quarter point increases in the next 6 months. In the long term, if the economy slows, we can expect the Fed to reduce rates, but no one expects them to be as low as they were 24 months ago. To put it in perspective, today the prime rate is 8%. If you look back 10 months ago, it was 4.25%. It's a 4.75% move. That has an impact. 30-year mortgages are currently 6 to 6.25. If you look at just a simple $300,000 mortgage 1 year ago, that payment would have been about $1,200 a month. Today, that payment's going to be about $1,900 a month. That's a $700 increase. So, I think the banks are open for business, and we want to lend. The economy is good. We don't see any credit quality issues, but that cost of doing business right now because of interest expense is kind of a game changer, and what works for a company. And that has a little more to do with it.
And in terms of, this is I suppose the second major banking crisis we've had in the last 10 years, of size. What have we learned? We seem to be going through this in cycles, but what have we learned as a bank? What do the banks learn, and what do their customers learn that from these crises that we may be trying to improve upon?
I think what I would do is I'm going to use Ameris Bank as a comparison, but you could plug just about any bank into this. After the last crisis, there were a lot of changes in the banking relative to capital, and that was the biggest thing. And what I want to do is I want to ensure everyone that the banks out there today are well capitalized. But at the end of the day, good credit quality with a steady, diversified income stream that has a diversified loan and deposit portfolio is the way to go. There really just isn't a substitute for good management. And unfortunately, I think in the 2 examples that have happened here recently, that's one of the failures.
Okay, I should correct myself. It's 15 years. It seems like it was less than 10 years, but
it feels like it was yesterday.
Yeah. I guess what advice could you share to the to your business customers and to the people on this webinar? You know, you've got FDIC programs to protect up to 250,000 in capital for most bank deposits, but that seems like such a small amount when you're a startup company and you're starting to bring in revenue as well as investment capital, and you're trying to keep it safe and well protected because you know you got to make payroll next week, maybe even next day. So what kind of advice can you offer to those founders and people managing those type of finances?
I would say start your relationship early, stay in touch with your trusted advisors, including your bankers. Also, there are products and services out there that can provide FDIC insurance on deposits over $250,000. I go into a lot of detail about that, but it's something you're interested in. Please keep Ameris Bank in mind. I'd love to talk to you about
it. If the banking situation, as you see it, is probably not a primary risk in this space, are there other things that you're worried about, or other areas that your customers or the people on this webinar should be keeping a close eye on going forward?
Yeah, absolutely. The biggest risk I see today is fraud. And I'll give you an example. Every time you give someone your check, you're telling them the name of your company or your personal name, your address, the bank you bank at, and your account number. I would just suggest talking to your banker and learn more about how you can protect your money. There's some slick people out there, and I have conversations once or twice a week with folks that are having those issues. It's a big problem. I'll give you another example. 2 years ago, fraud was probably a $1.5 million problem for our bank. Today, it's an $8 million. So much so we set up our own fraud department. I mean, it's rampant right now. Be careful.
Okay. And there are advice and services that Ameris Bank or banks of your type can offer for that specific situation?
Absolutely.
Okay.
Absolutely.
Well, I want to open it up. We've worked through a number of the topics looking forward and the bank's response and kind of the situation. I want to open this up to questions from the audience. I don't know if you want, you can, I believe you can come on directly and ask us through the webinar, or you can send us a chat and we will try to respond to your questions as we can. Does anyone have any specific questions for myself or for Richard? Right. Richard, is there anything else that we didn't discuss that we should have?
I think so. You got it covered. Thank you, Matt.
All right. Well, I want to thank Ameris Bank. As many of my team know and SCRA knows, you are a big supporter for SCRA and a contributor to our Industry Partners Fund, which is a fund that keeps us solvent and can be a fund that can be contributed to by any industry within South Carolina, as well as any industry, or as well as any individual within South Carolina, as part of a tax deferment to the state of South Carolina, and is a way that we fund our activities. And we want to thank you for that and appreciate your time and effort for today, but also your support of our programs and our efforts. So, and with that, I would like to thank all the attendees for being here today. And if you have any further questions or follow-up questions, please feel free to reach out to us or to your SCRA representative, and we would be happy to either answer those questions or direct them to Richard as appropriate, and see if we can get some answers for you. Thank you, and everyone have a great day.